Disclaimer. The content provided on this channel is not financial advice and is for entertainment and educational purposes only. Please consult with a qualified financial advisor before making any financial decisions. Welcome. My name is Rees, and this is my channel Echo and Vision. If you're interested in, make sure to subscribe to the channel and hit the thumbs up button for support. How to invest in real estate. Understand the basics of real estate investment before diving in. Familiarize yourself with the different types of real estate investments. 1. Residential properties. Single-family homes, apartments, condominiums, etc. 2. Commercial properties. Office buildings, retail spaces, warehouses. 3. Industrial properties. Factories, storage facilities, distribution centers. 4. Land. Undeveloped land that can be used for future development or leasing. 5. Real estate investment trusts, REITs, companies that own and operate real estate. You can invest in REITs like stocks. 6. Short-term rentals, Airbnb or vacation rentals. Assess your financial health before investing. Ensure you're financially stable. 1. Check your credit score. A higher score gives access to better mortgage rates. 2. Save for a down payment. Typically 15-25% of the property price for investment properties. 3. Set up an emergency fund. Keep funds for unforeseen expenses. 4. Calculate your debt-to-income ratio. Lenders usually prefer a ratio below 36%. Determine your investment strategy. Choose the strategy that aligns with your goals and risk tolerance. 1. Buy and hold. Purchase a property and rent it out for long-term income. 2. Fix and flip. Buy properties, renovate them, and sell for a profit. 3. Real estate syndication. Partner with other investors for larger projects. 4. Short-term rentals. Invest in properties to list on platforms like Airbnb. 5. Crowdfunding platforms. Invest smaller amounts in large-scale projects online. Research the market. 1. Location matters. Look for areas with growing job markets, good schools, low crime rates, and future development plans. 2. Understand market trends. Study property values, rental yields, and demand. 3. Analyze competition. Check other properties in the area and their rental or sale prices. Secure financing. Explore your financing options. 1. Conventional mortgage loans. Ideal for long-term investors. 2. Hard money loans. Short-term loans for fix and flip projects. 3. Private money loans. Borrow from private investors. 4. FHA loans. For beginners, though usually for primary residences. 5. Cash. Avoids interest payments but ties up capital. Analyze properties. Evaluate the potential profitability. 1. Rental yield. Compare annual rent to the property price, e.g., aim for at least 8-12% gross rental yield. 2. Cash flow. Ensure rental income covers mortgage, taxes, insurance, and maintenance, leaving profit. 3. Capital appreciation. Assess how much the property value could increase over time. Conduct due diligence. 1. Inspect the property. Hire a professional inspector to identify issues. 2. Review local laws. Understand zoning regulations, rental laws, and tax implications. 3. Check title and ownership. Ensure the property has a clear title. Purchase the property. 1. Negotiate the price. Use your research to negotiate a better deal. 2. Hire a real estate agent, especially useful for first-time investors. 3. Work with an attorney to ensure the legal aspects are clear. Manage the property. 1. Self-management. If you have time and expertise. 2. Hire a property manager. Ideal for reducing your workload. They handle tenant relations, rent collection, and maintenance. 3. Tenant screening. Always vet tenants carefully to avoid problems. Monitor and optimize performance. 1. Track expenses and income. Use tools like property management software. 2. Perform regular maintenance. Prevent costly repairs in the future. 3. Review rent rates annually. Adjust based on market conditions. Diversify your portfolio. 1. Invest in different types of properties, e.g., residential, commercial, short-term rentals. 2. Spread investments across various cities or regions to mitigate risks. Leverage tax benefits. 1. Depreciation. Deduct the cost of the property over time. 2. Interest deductions. Mortgage interest is tax deductible. 3. Repairs and expenses. Maintenance, utilities, and property management fees are deductible. 4. 1031 exchange. Defer capital gains taxes by reinvesting profits into another property. Scale your investments. 1. Reinvest profits from rental income or property sales into new properties. 2. Leverage equity from current properties to finance additional purchases. Stay educated and network. 1. Attend real estate seminars. Learn from industry experts. 2. Join real estate investment groups. Network with like-minded individuals. 3. Follow market trends. Stay updated on economic shifts, interest rates, and local development projects. Common risks and how to mitigate them. 1. Market risk. Diversify your portfolio and stay informed. 2. Liquidity risk. Have a contingency plan for selling properties. 3. Tenant issues. Screen tenants carefully and maintain good landlord-tenant relations. 4. Property damage. Invest in insurance to cover unexpected events. Advanced real estate investment strategies. House hacking. 1. Purchase a multi-unit property, e.g., a duplex or triplex, live in one unit, and rent out the others. 2. The rental income can help offset mortgage payments or even cover them entirely. B. BRRRR method. 1. Buy. Purchase an undervalued property. 2. Rehab. Renovate the property to increase its value. 3. Rent. Lease it out to generate cash flow. 4. Refinance. Take a new mortgage based on the increased property value. 5. Repeat. Use the refinance proceeds to invest in another property. C. Wholesaling. 1. Find undervalued properties, get them under contract, and sell the contract to another investor for a fee. 2. This strategy requires little to no upfront capital. D. Real estate partnerships. 1. Partner with others to pool resources and share risks. 2. Useful for large-scale projects like commercial real estate or multifamily units. E. Vacation rentals. 1. Invest in properties in popular tourist destinations and list them on platforms like Airbnb or Vrbo. 2. These often have higher rental income potential but may require active management. F. Seller financing. 1. Negotiate directly with the property owner to finance the purchase. 2. This is beneficial if traditional lenders are unwilling to provide a mortgage. Legal and regulatory considerations. A. Landlord-tenant laws. 1. Familiarize yourself with rental regulations in your area, such as eviction rules, security deposit limits, and tenant rights. B. Zoning laws. 1. Ensure your property complies with local zoning regulations, especially for short-term rentals or commercial use. C. Tax implications. 1. Consult a tax professional to understand how real estate income will affect your tax obligations. 2. Consider setting up a legal entity, like an LLC, for liability protection and potential tax advantages. D. Insurance. 1. Purchase property insurance to protect against natural disasters, liability claims, and other risks. 2. If you're renting, consider landlord insurance to cover rental-specific risks. Building a team of professionals. Real estate investing often requires collaboration with experts. Build a reliable team that may include 1. Real estate agent. Helps you find the right properties and negotiate deals. 2. Real estate attorney. Ensures all transactions are legally sound. 3. Mortgage broker. Assists in finding the best financing options. 4. Property inspector. Identifies potential issues with the property. 5. Contractors and handymen, for renovations and repairs. 6. Accountant or CPA, manages tax implications and financial planning. 7. Property manager, handles daily operations if you don't want to self-manage. Real estate investment technology. 8. Research and analysis tools. 1. Zillow, Redfin, Realtor.com, for property listings and market trends. 2. Mashvisor, Roofstock, analyze rental property potential. 3. CoStar, LoopNet, specialized for commercial real estate. B. Property management tools. 1. Buildium, Appfolio, manage tenants, collect rent, and track maintenance requests. 2. Rentometer, analyze rental rates in your area. C. Financial tools. 1. Mortgage calculators, estimate payments and interest costs. 2. Excel or real estate investment software, track cash flow, ROI, and other metrics. Exit strategies. A good investment plan includes an exit strategy for maximizing returns. Common exit strategies include: 1. Sell the property. Sell when the property appreciates significantly in value. 2. Refinance. Extract equity while keeping the property for cash flow. 3. 1031 exchange. Defer capital gains taxes by reinvesting in a like-kind property. 4. Lease option. Sell the property to a tenant who leases it first with an option to buy later. Real estate investing pitfalls to avoid: A. Over-leveraging. 1. Taking on too much debt can backfire if the market shifts or cash flow decreases. 2. Always maintain a cash reserve for emergencies. B. Neglecting due diligence. 1. Failure to research the property or market can lead to overpaying or missing potential issues. C. Underestimating costs. 1. Account for all expenses, including maintenance, taxes, insurance, and vacancies. D. Emotional decision-making. 1. Avoid falling in love with a property. 1. Make decisions based on data and investment potential. E. Poor location choice. 1. Even the best property won't perform well in a declining or stagnant area. Scaling your real estate business. A. Use leverage wisely. 1. Reinvest profits and use financing to scale your portfolio efficiently. B. Automate processes. 1. Use property management software or hire managers to handle routine tasks. C. Diversify asset classes. 1. Invest in different types of properties, e.g., residential, commercial, industrial, to spread risks. D. Explore joint ventures. 1. Partner with experienced investors to undertake larger, more complex projects. E. Build passive income streams. 1. Focus on properties or strategies that generate consistent cash flow with minimal involvement. Sustainability and ethical investing. Real estate investors can adopt sustainable and ethical practices. 1. Green buildings. Invest in energy-efficient properties. 2. Affordable housing. Provide housing options for low-income tenants. 3. Community development. Focus on revitalizing underserved neighborhoods. Ongoing education and networking. A. Stay updated. 1. Regularly read real estate blogs, attend seminars, and take courses. 2. Subscribe to industry newsletters or podcasts. B. Join real estate groups. 1. Participate in local real estate meetups or online forums. 2. Networking can lead to partnerships and off-market deals. C. Learn from mistakes. 1. Every investor makes mistakes. 1. Analyze and learn from yours to improve. 1. Conclusion. 2. Real estate investing offers a pathway to build long-term wealth, but it requires patience, knowledge, and a strategic approach. 2. Start small, gain experience, and gradually scale your portfolio for greater returns. 2. If needed, consult with real estate professionals to guide you through the process. 1. Final boost. 2. Remember, every like and subscribe helps this community grow stronger. Together, we can make financial freedom a reality for everyone who's ready to take action. Thanks for watching, and I'll see you in the next video.